I just wanted to cover a little bit about rejection blocks. For those that don't know what a rejection block is, it's the last PD array before a previous high or a previous low according to the ICT PD array matrix. For example, this low is sell side liquidity or a previous low, and this high is buy side liquidity or a previous high, right? Same goes with this high and this low. So when I say that it's the last PD array in the PD array matrix, I mean there's obviously fair value gaps, and there's obviously volume imbalances and other blocks and all those PD arrays in between. A rejection block is the last one because it's the one that's created where we got somewhat relative equal lows or relative equal highs. For example, we have these two bodies, this bearish candle and this bullish candle. We can see that the bodies are relatively equal. Sometimes it's perfectly equal, like in this instance here where we see that they're perfectly equal, but we might not get the same all the time, right? So that's why I say relatively equal. So wherever we get the relative equal lows in terms of the bodies, we can draw out this area and this becomes our rejection block. It's called a rejection block because it's where price has rejected from some other PD array, or for whatever reason in time or price, we rejected away aggressively from the previous area, right? Creating this long tail or long wick. Whenever we get that long tail or long wick, we can look to see if price can respect that area to continue higher or lower depending on what bias you might have. So let's quickly go through some examples. This will be a very short video, and I'm going to ask now while we're here, if you do find some sort of value in this video, if you find yourself learning something, even if it's something you already know but you just like the content, please do not forget to tickle the like button below, and while you're there, just subscribe if you're not already subscribed. But yeah, a rejection block, from my studies and tinkering around, I realized that it's the one PD array that firstly is in an extreme premium or extreme discount. So it's very high probability when you're dealing with choppy market conditions, right? I say that's the case because you might get price moving like this, right? Price moving in a very choppy manner like this. I say this is high probability because if you notice, price tends to gravitate towards extreme premiums or extreme discounts before looking for a continuation higher or lower. Of course, it depends on what bias you're looking for, and that's where you get rejection blocks being used a lot, especially with pairs like gold or Euro GBP, for example. Something that's extremely choppy, you would find that rejection blocks are used there a lot. The second thing that I realized is that a higher time frame rejection block is also a lower time frame breaker, mitigation block, or order block. And that's just from my personal studies and watching price action. Let's see what this to be completely candid, I have not actually looked at this chart. I've not actually looked at any other time frame besides this time frame, the 4 hour, but I'm curious to see what this area here is on a lower time frame. So let's go down to the hourly chart and see what it might be. On an hourly chart, it's still an area of rejection, and we can actually consider this to be an order block, the last down close candle before we finally pushed away from price. This very last down close candle. When we go down again to the 30 minutes time frame, we can see that it's still order blocks in a way. Might not be the highest probability order blocks to you and your style of trading, but we can see that it's an order block that was already respected and rejected away from it. On the 15 minutes, we start having a bit more structure now. On the 15 minutes, it looks more like a mitigation block. I say it's a mitigation block because if you notice, we did not take liquidity from here to there. We didn't take any liquidity. If we took liquidity, it was going to be a breaker. So we didn't take liquidity and we had a market structure shift with a fair value gap over there and an entry to continue higher. So we can see that the lower the time frame we go, the more detail we get to see inside of this one rejection block. And that's exactly why it's the last PDRA. That's exactly why if we are going to respect any PDRAs in the extreme discounts or extreme premiums, it should be that rejection block, right? Because going through that, of course, we just have sell side liquidity. Let's clear this up and go find another one. Let's see. I think this one right here is good enough. So here we have this rejection away. We don't know what it's rejecting from. It doesn't matter to us right now. It could be an inverted fair value gap, for example this. It could be an even higher time frame PDRA. It could be whatever it is. But the fact is that we had a rejection there away from this swing low, right? So we took liquidity firstly, and then we rejected away from that swing low. I'm not going to keep that line there, making this now to be a rejection block, right? From the equal bodies to the bottom, which is the swing low or swing high, depending on what scenario you're dealing with. And we can actually see price came to the extreme discounted level just to reject away from it, and even went to clear that buy side liquidity where the low came from, where this low came from that high. So we went and took it eventually. So let's see on a lower time frame what this rejection block could possibly be. I'm not saying that I know what it is, but let's just see. On the hourly chart, I see that it's a nice high probability order block already. For those that have been following my channel and teachings for some time, it's not really my teachings, I'm just regurgitating what I have learned from experience and other educators that I follow. So yeah, we can see that a high probability order block is one that took liquidity. That's the first thing that I need in order to gauge a high probability order block. So you can see we took liquidity here and immediately expanded away from it. So down, that makes this entire down close candle to be a high probability order block in my opinion. So we got this whole candle, pull it out in price and time, and we can see price came to the mean threshold, which is the halfway point of this entire bearish candle right there, and rejected away. But that same bearish candle just so happened to be a 4-hour rejection block. As I said, it could be an order block, it could be a breaker, it could be a mitigation block. It's basically any block that you can think of. They all work together depending on the time frame you're on. On the 30 minutes chart, we can also see the same sweeping liquidity and expansion away from it, making this to be a breaker as well. So even though on the 1 hour chart this entire candle was a down close candle, here we can actually see an up close one before the down close one. So that makes that to be our breaker, and that's exactly the same area price rejected away from. 15 minutes. On the 15 minutes, I don't see much that's actually clear there, so I'll skip that. And then finally the 5 minutes, we have also somewhat of a scuffed up mitigation block. A low, failure swing, and then expansion higher. But that's not one that I would take any day at all. So yeah, the point of this very short teaching is to just show a few examples of a rejection block and the significance. I know a rejection block is not the most trusted PDRA, in my opinion at least. It's not one that I would use to enter every single trade, but it is a PDRA that I would look for when it comes to very choppy markets, or a market where I'm looking for high risk reward ratio. that's the second thing I wanted to show, is that a rejection block, because you're looking for an entry between those equal bodies and your stop loss being at the swing low, because if we take the swing low, that's sell side liquidity. Because you're looking for that, any trade you do take off of a rejection block is going to yield you a high risk reward ratio, like you can see in this instance, right? From the entry there to the buy side liquidity there gave us almost a 7-to-1 risk reward ratio. So that's the main advantage of a rejection block. If all your trades are basically based off of a rejection block and you had a 20% win rate, some win rate that's actually lower than a flip of a coin, you're still going to end up profitable because of the, well, generally speaking, I'm not saying this is set to stone, but generally speaking, you're still going to end up being profitable because of the high risk reward ratio that your trades would have. But yeah, that's basically a rejection block. It's basically another breaker or another order block or another mitigation block in a different time frame, but it's the last PDRA in the PDRA matrix. So for now, take care of yourself. Don't forget to click the like button below, subscribe. Good luck, and of course, as always, good trading.